Alright guys, welcome to another video here on the channel. I am Justin on the charts, and we're going to be diving into a strategy that I've been working on recently. I got this mostly from Dodgy's DD. Shout out to him. Watched a bunch of his YouTube videos, kind of sort of took the strategy from him. I don't know if I'm doing it exactly the way he does it, but that's the great thing about trading is you can take a strategy, take a concept like the ICT concepts, and you can tweak it and creatively make it your own thing and make it work for you, and then back test that to figure out what is the win rate, what is the risk reward ratio, how frequently does this trade occur on the charts, and that's what we're doing today. So I've been back testing this strategy. There's really two strategies here. There's like strategy A, strategy B. I'm still trying to figure out which one specifically has a higher profitability, higher probability, higher win rate. And but they both appear simultaneously sometimes, either back to back or like as a part of the same move, and I'll explain that to you here. So we are on the 5-minute chart here looking at this. I have my sessions marked out: Tokyo session or Asia session, London session here, and I'm gonna mark off really quickly. Right now we have this high and we have this low that have been unmitigated, and then we have Asia low all the way down here that hasn't been touched, and that's probably good for now. We're already above or at the New York high. All right, so looking at this chart, like if you came to visit the charts right here, this is roughly 7:20 a.m. What I found is the strategy frequently presents itself between 7:30 a.m. and like 9 a.m. before New York open, and then presents itself again mid-morning, and then maybe again in the mid-afternoon. So this strategy specifically presents itself, I would say, 2 to 3 times a day, potentially. Sometimes less, sometimes more. So we're looking at this. What I'm waiting for is a liquidity sweep. This is like a basic ICT concept. There's liquidity above highs and lows that have not been tapped into. So we're waiting for liquidity sweep. We go through, and sure enough, we have a sweep of those highs there. All right, so we have that sweep. By the way, this is a indicator that I've made myself. I will, if you want to find it, my trading view is Justin on the charts. I have a few different indicators I've made, but this is the fair value gap, inverse fair value gap, all time frames indicator. So what it does is it marks out fair value gaps that are created on any time frame, whatever time frame you're on at the moment, and then it turns colors. It changes color when that fair value gap has been inversed. So like example here, we had a fair value gap between these wicks with this candle in the middle. This gets inversed, that turns green. So that's what's happening there. By the way, for now, I'm going to go and turn off trading sessions just to make this chart a little bit cleaner. So long story short, we have this fair value gap that's been made. So we swept liquidity, and in the process, we made this fair value gap here. What I'm waiting for now is, this is on the 5-minute, by the way, I'm waiting for a 5-minute inverse fair value gap. So we continue waiting and inverse. It actually inversed 2 here. We had stacked fair value gaps. And this is one thing I learned from Dodgy's DD is you're going to treat these as basically one kind of cumulative fair value gap between the two. If they're stacked, you want to treat them as one, because if it inverses just one, it maybe could reject off of the lower one and then continue back up. So it's actually really good. This candle inversed both. Changed color on this indicator. Now what we would do is immediately take entry when this candle is closed. We put a short position here, and with the stop loss, we're going to place that just above this fair value gap that we just inversed. And then for the take profit, you have all of these lows you could target. And this is where the draw on liquidity becomes important, because you're wondering, where's price likely going to go? Where's that liquidity draw coming from? It's any of these lows that could be that next draw on liquidity. We could target this low here. We could target this low, this low. We could target all the way down here if we wanted to at these lows. Any of these are potentially valid with this trade, with this strategy. So I don't know at the moment what I had done. Let's say I shoot for this here. That's a 1 to 1.84, relatively low risk reward ratio. But I mentioned this in a previous video that the lower the risk reward ratio, sometimes that means you get a much higher win rate, and that's a trade-off you have to kind of balance out. But let's say we put an order there. We will do, let's say, 10 micros. And we are waiting for price to hit stop loss or take profit. And let's just let this ride. So I'm going to let this play out. And goes up a little bit into our drawdown. Bam. Hit our take profit. Let me go back a little bit. Beautifully. Easy win right there. Easy. Not much drawdown when about halfway to our stop loss. That is kind of strategy A, strategy 1, like part 1 of this A-B strategy. Once that is played out, I'm then shifting into strategy 2 or B, the second part of this. What I would be looking for now is I would switch to the 3-minute time frame. For some reason, the 3-minute OTEs seem to hit very well, and I'll give a shout out to Matthew Scriv. He does the 3-minute OTEs with entry at the 0.705. Very profitable at that, and I'm in his Discord. Great guy. Highly recommend checking that out. But anyways, that's kind of partially where I got this from. But what I was noticing was a lot of times, at least in this scenario, with liquidity sweep plus inverse value gap on the 5-minute, I was noticing personally it wasn't always going all the way to the 0.75 on this fib. It was going to the 0.5 and then rejecting off of that. So that's kind of where I developed this take on the strategy from. We are going on the 3-minute time frame, drawing out the fib from wick high to body low. If this was a liquidity sweep of a low, it will be reversed. But because we're looking for price to go downwards, we start at the peak and go to the lowest candle and go to the bottom of the body of that candle. If we go lower, okay, so it's actually right here. If we went lower, I would just continue moving this down until I found the bottom, and that would change where our entry would be at. And what we are looking for once again is an entry off of the 50% of this range here. I'll put a short position here at 870.25. And once again, this is different with Matthew Scriv's strategy. For this specific strategy, what I've been testing is entry or stop loss at the 0.79 on the fib. So what I have marked out, by the way, is the 0, the 1, and in the middle I have 0.5, 0.705, and 0.79. Those are important numbers that I like to look at. So stop loss is going to be at the 0.79 of this range. And take profit, if you want to be really safe, you could probably put it at the 0 on the fib. I'm going to place it at the wick low. So that's kind of the general concept of these fib levels, is you're looking for where price might retrace to before continuing in that same direction. So theoretically, if this is to play out ideally, it should be going below where this previous low was. It should retrace somewhere in here and then come back down. And that's exactly what happened in this scenario. So you caught strategy A for the first part of it, and then it's making its retrace now before it goes even lower. And we're trying to catch that. We put in entry here at that 0.5. I will once again do 10 micros, and we wait for price to hit that level. And what you will see if we let this play out, we get tagged in. I'm going to put my stop loss up here and my take profit all the way down here. And watch how this just continues to play out beautifully. Bam. 2 super easy trades. This one specifically, very little drawdown. We're looking at like 3 points of drawdown. These both came from the same thing here. We had a liquidity sweep of a key higher low. We had a 5-minute inverse for value gap. The value of that inverse for value gap is that it's giving us confirmation that this is continuing in that direction, that this wasn't just a little quick fake liquidity sweep before it goes even higher. That 5-minute inverse for value gap tells us price probably does want to come down. We enter on the continuation there. I'm going to call strategy A continuation. We entered off the continuation, rode that down to the previous low, and then we are now looking for the retrace, entering off of the 3-minute OTE at the 0.5 level, 50% of the range, and then riding that back down to a new low. And in this case, I don't know if we actually Yes, we did. So in this case, we actually did go all the way down to these lows down here that we had marked out previously. So if you wanted to, on that first trade there, on that first continuation entry, you could have just targeted these lows out the gate. Instead of stopping here at this low where we had targeted, you could have targeted all the way down here, and you could have ridden it. It would not have stopped you out. So that fair value gap was right. Hold up, we're on the wrong time frame. So that fair value gap was right here. When we had our initial stop right above the fair value gap, ironically, this new stop loss was right about the same spot. And you would have never gotten stopped out on that first trade. You would have entered right here, rode that all the way down. But I guess the benefit of this is maybe you get more points if you do both. And then once again, like I mentioned, I'm backtesting still to figure out, is the win rate of this like better if you just do continuation, or better if you just did OTE, or are you better off trying to do both? Because the other problem is sometimes before your first strategy A has played out fully, it starts doing the retrace for strategy B. And so in those scenarios, I'm like, do I hold on to this trade and let it go back some before going back down? Or do I close out and then try to re-enter? So there's a little bit of a nuance there that I'm still trying to figure out. But regardless, these are two setups that you can catch off the same thing that happens 2 to 3 times a day that I've been having pretty good success with. And I'm still backtesting, still paper trading, so take this with a grain of salt. I am by no means a financial expert. This is not financial advice, but it's something that's been working for me decently well in paper trading. So with that, I hope you guys enjoyed the video. Once again, we are just going through a bunch of different strategies, backtesting, learning, and I'm glad you guys are here for the ride. So thank you for watching. See you in the next video.